All right, I love financial statements, and so do you. But there's a need to do financial statement analysis. The financial statements in and of themselves, the balance sheet, the income statement, statement of cash flow, is just beautiful. What a beautiful set of things. But if we could analyze them a little bit more, squeeze some more data out of them, they'd be so much more useful. So we need to talk about financial statement analysis. Financial statement analysis is the examination of relationships or relations among financial statement numbers across time for the same company. Let's look at a certain number or a relation of numbers in a company last year, the year before that, and compare that to this year and see if we can see trends. So the same company over time and across companies at the same point in time in the same industry. So let's look at the numbers for Microsoft, and maybe we'll compare them to the numbers for Google. We'll compare them to the numbers for Apple. They all don't do the same thing, but let's just get a sense of a comparison. Maybe we'll look at them in comparison to the numbers for the company Oracle. Again, they do a little bit different things, but let's just see where Microsoft sits in comparison to other companies right now. Now, a relationship between financial statement numbers is called a financial ratio. I'll give you an example of a quick one, or an easy example. Net income divided by sales. Net income divided by sales. That's a financial ratio. It's the ratio of two numbers. Its interpretation, it's called return on sales. We'll learn more about it later. How many pennies of profit are left from each dollar of sales? Or if you want to think of it in larger terms, if I have $100 of sales after I pay all of my expenses, how many dollars of net income am I left with? Well, let's see what that is for this company this year. And see what it was last year and the year before. Is our profitability going up or is it profitability going down? Now, let's look at other companies in our same industry right now. Are they high or are they low? So financial ratio, the ratio of two financial statement numbers. We want to look at the relations, these relationships across time for the same company. What's the trend? And compare to other companies in the same industry. That's a nice snapshot view of an introduction to financial statement analysis. What does this financial statement analysis do for us? Well, we're doctors here. We're doctors of companies, okay? And we're looking at test results, as doctors always do. Well, okay, we've done our financial statement analysis. These are the test results. And we can do a diagnosis. What's wrong with this company right now? You've got too much inventory. You've got too much property, plant, and equipment. Your wage expense is too high relative to the amount of sales that you've got. We can diagnose your problems right now. So you're sick, we'll tell you what's wrong with you. That's one thing we can do with financial statement analysis, diagnosis. Another thing we can do with financial statement analysis is prognosis. We can tell you how you're going to do in the future. We can see right now that your profitability is much higher than any other company in your industry. So we predict that over time, you can't maintain this super high level of profitability. You're going to have to go down and become more in line with other companies in your industry. Or maybe you're low compared to other companies in your industry. We expect you to go up in the future. Or maybe you've got too much inventory relative to other companies in your industry. And if you implement our suggestions to get more efficient at managing your inventory level will go down, which means you need less financing. So your interest costs will go down. We can predict what's going to happen in the future if certain things happen. Financial statement analysis, we can tell you what's wrong with you. We can give you a diagnosis, and we can also tell you how things are going to unfold in the future, especially how things are going to unfold in the future if you make certain changes, do certain things differently that will impact your financial statements. Diagnosis and prognosis. Two common methods of financial statement analysis. Ratios. Net income divided by sales is a good ratio. We call it return on sales. How many dollars of net income are left over from every $100 of sales? So that's a ratio, relation between two financial statement numbers. Another very easy and powerful, and so there are lots of ratios. This one that looks at profitability of each dollar of sales. We can compare your cost of goods sold and your inventory and say, do you have too much inventory sitting around? There's another ratio that we can look at that will tell us that. Lots of individual ratios. Also, a very powerful and simple technique is the preparation of common-size financial statements where we just divide all financial statement numbers by total sales for the year. And it's always amazing to me how much information you can get by just that simple thing. Okay, we got the income statement. Now let's just take the income statement. Every item we'll divide it by sales and turn it into a percentage. You got the assets in the balance sheet. Let's take every one of those asset numbers and divide it by sales for the year and get a percentage. Powerful information from this that's just called common size financial statements. So those are two common methods of analysis, common methods of financial statement analysis.